Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at Netflix Q4 earnings, which were just reported after hours today. So let's get started. The first thing we're going to take a look at is just how the overall market has reacted to their earnings. It closed at 338. When some of the reports came out, the price dropped down all the way to $330. But after the earnings call, the price is sitting at a 2.2% gain at $345. All right, so here I pulled up their shareholder letter. This is the information they've provided to us so far. Right now, we're going to be looking at Q4 of their earnings. And to start off, they bring full year 2019 of revenue to over $20 billion. This company produces a big amount of revenue. And here we can see I have highlighted all the important information already, so we can do this pretty quick. Revenue year-to-year growth for Q4 was 30.6%. That's pretty impressive, right? A company is still growing 30.6% year-to-year growth. And we can see last Q3 was 31.1. Q2 was 26, Q1 was 22.2, and Q4 last year was 27.4. So this company is growing, it still continues to grow its revenue at a high pace. So this is definitely still a growing company. For Q1 of 2020, they forecast 26.8% revenue growth compared to the same time last year, and they're expecting revenue of $5.7 billion. Operating margins for this company also is something that is pretty up and down. For Q4 2019, their operating margins was 8.4%. Last quarter was 18.7. The quarter before that was 14.3, and the quarter before that was 10.2. One thing I do remember, this is not my first time taking a look at Netflix information. I know that one of the things is they were waiting for a big time charge that was going to happen, and they kept being pushed back quarters and quarters. Initially, it was supposed to happen between Q1 and Q2, but it ended up not happening till now Q4, and that's one of the main reasons operating margins is so low at 8.4%. But look, for Q1 of 2020, they forecast operating margins of 18%, which is again what seems to be their high point of this year, their Q3 of 18.7. One thing I also want to have you guys shown here is the operating income for Q4 2019 compared to the net income. Normally, the net income, which is after every expense has been done, is lower than your operating income. But the case is different here. Operating income for Q4 was $459 million. Net income was actually higher at $587 million. And normally you don't see that. That's something that does not happen. And no, it was not a mistake. The reason that we'll take a look at it in a bit is this company had a tax benefit, so they ended up collecting a net income. They ended up providing a higher net income than operating income due to that tax benefit. But we're going to see that this diluted earnings per share, which was pretty good at $1.30, is not true $1.30 because of that tax benefit. Earnings per share for Q3 was $1.47. For Q2 was 60 cents. For Q1 was 0.76, and for Q4, same time last year, was 30 cents. And you're going to see right now, based on that tax benefit, the earnings per share are actually pretty much the same compared to the same time last year. For Q1 of 2020, they forecast earnings per share of $1.60. That's actually pretty high. So I'm going to have to end up seeing in their 10Q report when they post it on why they expect it to be so high. Next, let's take a look at their global streaming membership. Their streaming paid membership is also growing at a nice rate. Q4 of 18 was 25%. Q1 of 19 was 25%. Q2 of 19 was 21%. Q3 was 21%. Q4 this now that we're reporting is 20%, and Q1 of 20 is at 16.9%. So you can see, even though they're still growing in double digits, it does seem like a slowdown is happening. right? So from 25%, we can see a small decline every quarter to about 16.9 in quarter 120. So for quarter 4 results, the average return per user, the average revenue per user increased over 9% year over year. That's actually pretty impressive. So they're collecting more money per users now than they were over a year ago, 9% more, and that's actually pretty impressive. And I'm pretty sure it has to do a lot with increase in costs that they have been doing in a lot of places. And if you exclude foreign currency, if there's always some form of impact due to foreign currency, the average revenue per user has actually increased 12% instead of 9%. Next, let's talk about global paid membership. Here we can see, first let's take a look at the graph of global paid net additions. 2018 was a strong year for them. It's been the strongest so far, and we can see 2019 is not that far behind. In quarter 4, they added 8.8 million users, and that's actually similar, on par with 8.8 million same time last year. And this is ahead of their forecast. They had forecasted 7.6 million users to grow. And again, this is something that I know because I've read, I've done analysis on Netflix numerous times. Netflix is one of the few companies that when they report estimates for upcoming forecasts, they do numbers that they think that they can reach if they work hard enough. When most companies usually undershoot a forecast just because they're worried that they might fail, so they undershoot. Netflix actually does the opposite. I feel they overshoot most of the time, and that's why we saw there's sometimes when this company actually misses their own forecast, and I think that's actually a pretty impressive thing to do. We can see that they added most of their memberships this quarter from Europe, Middle East, and Africa, the Latin America continents, and APAC, Asia Pacific, and China, Australia and China, I believe, regions. So we can see a lot of the growth they're coming from comes from international and not from here in the States. United States and Canada net adds were 0.55 million, and 0.42 million were in the United States. And this is compared to 1.75 million a year ago. So you can see from 1.75 million a year ago to 0.55. There is a slowdown here in the United States and Canada region. And one can argue that this is happening because United States and Canada are one of their most developed countries where they have it. So obviously you will start to see a slowdown here. But they do mention that their low membership growth in United States and Canada is probably due to the recent price changes and also to the competitive launches. So they are saying that could be impacting them, but it's not deterring them from increasing prices. For quarter 1 2020, they forecast global paid net adds of 7 million. And we can see here they already have the nice chart for us that what they're forecasting for quarter 1. And it'll be higher than 2017 and similar to 2016, but much lower than 2018 and 2019. In 2019, they did 9.6 million, and now they're only expecting 7 million. So you can see there is a slowdown happening for this country. For operating margins for 2020, they are targeting 16%, and that would be about 300 basis point year over year. So that means for this year of 2019, their operating margin was sitting at an average of 13%. The next thing they talk about is content, and they discuss a lot about the shows they have and the kind of shows that are coming up this quarter. There's a lot of shows here that I'm not going to talk about much. It's just they definitely have a lineup coming in, but there's some of the things I do want to talk about. During December, they launched The Witcher, which is tracking to be their biggest season 1 TV series ever. They have a nice chart that shows this, and this is pretty impressive. And they also mentioned that as a testament to how our hit content can penetrate the global market, the show launch drove up the sales of the Witcher books and games around the world. So this is something that Netflix can actually use to bolster, to get more shows like this. They can be like, hey, if you put a show here on Netflix, you're gonna expect higher revenue in your other products. Another thing they talk about is that local originals were the most popular titles in 2019 in many countries, and this is pretty good. Pretty cool. They are Netflix is making originals for different countries. Sometimes they're country specific originals, and they do mention that their local originals were the most popular in 2019. So this continues to strengthening their thesis that they should continue to make more original content. And this is another thing I like hearing about. Right now, at the price Netflix is staying at, I wouldn't say I'm not too happy. I wouldn't enter it. I personally would not enter an investment, but I still like to understand how the company is behaving, to see if prices do go down, if I should enter. And right now, so I like to know everything about this company. Over the past several years, they've been developing an animation studio with Netflix to produce a wide array of animated content for kids, adults, and families. And they have creators who work for Disney Animation, Pixar, DreamWorks, and Illumination. So they're not working at Netflix, and that is pretty impressive. The animation studio is definitely a difficult task to accomplish. I was just reading Bob Iger's book, and he definitely talks about some of the troubles that Disney went because their animation studio was pretty weak. So you need to understand that an animation studio can really make or break these types of content. So it's pretty impressive that they have creators from all these amazing studios working here at Netflix. Next, we're going to talk about products and partnerships. Again, there's not much I found pretty interesting here. The only thing I found here is that in Q4, they launched a mobile-only plan in Malaysia and Indonesia. This is something I knew that they did in India in Q3 last year, and this is like it is. It's just a mobile-only plan. It allows you to watch Netflix on your phone, but you don't have any other form. You can't log in on the TV or on the computer. The only thing is this is a much lower price, and the reason they do this is because in countries like this, cable is actually lower price. So cable, you could be paying a cable for $15. So for Netflix to go to countries like this and pay and charge $13 for full service, it makes no sense when people would rather just have cable then. But they have this mobile only plan, which is roughly about $4 or $5, which makes it more attractive now. And the only thing I have an issue with that is, yes, they're collecting more memberships that way, but by dropping the price so low, their margins are also going to decrease dramatically. They do say that they expect the mobile only plan to be revenue positive. So here this was pretty cool that they were here they talk a bit about the competition. Despite the debut of Disney Plus and the launch of Apple TV Plus, their viewers per memberships grew both globally and in the United States year-over-year basis. And then here I think this was a power move that Netflix did. They took a Google Trends and they looked at The Witcher, which was Netflix's biggest show, biggest one-season show ever. Then they looked at The Mandalorian, which is one of Disney's biggest shows to come out, Morning Show, which is Apple Plus's biggest show, and Jack Ryan, which is one of Amazon's biggest show. And you can see that Netflix The Witcher is way above all the others in trends, and you can see how strong that customer is on the Netflix side. And this, just like I said, I think this was a power move for Netflix to show. And here you can see the average. Blue is The Witcher, and it's way above Mandalorian. And that was pretty impressive. I actually thought that The Mandalorian will have a lot more, especially with all the Baby Yoda memes going on. I was expecting a lot more from The Mandalorians. So next, let's take a look at the cash flow and capital structure of this company. The one of the biggest things I hate about this company is that it does have positive earnings per share, but that does not mean that this company is making money. This company is actually burning money, and it is burning money at a faster rate each year. For the full year, their free cash flow was negative $3.3 billion. That is insane. They are losing they literally burn $3.3 billion in cash, and that's something I don't like. I don't like to see. They do say that this is the peak, and they think every year from now on is gonna get better. I hope so. For 2020, they still expect a negative cash flow of negative 2.5 billion, and again, that's still a lot of money. And they are working slowly to become positive free cash flow, but see, I can't see them doing that anytime soon. If anything, I would have to say maybe in 2024, 2025 is when this company will eventually start seeing some free cash flow, some positive free cash flow. They are continuing to also build debt by senior notes. In Q4, they continue to raise $1 billion of senior notes at a 4.875 interest rates, and in Europe they did 1.1 billion euros at a 3.625 senior notes. Both of these are not due to 2030, and hopefully by then this company is free cash flow positive, that it is able to pay its debt down. And I've seen, I know if it was in Q2 and Q3, but at sometime in this year, they also pulled some more debt, and they are continuing to increase their investments by through the debt market. So I think we're almost coming up to the end. We're just going to take a look at this table one, and we're looking at the streaming revenue by sector. And the first thing I want to take a look at is the United States and Canada. Obviously, provide the biggest revenue, sitting at $2.6 billion. Next is Europe, Middle East, and Africa, sitting at 1.5. So you can see how United States is the biggest market. United States and Canada is this company's biggest money maker. And we can see the average revenue per user continues to grow. Right now in Q4, sitting at about $13.22. And that's because this company continues to increase the price of their membership. And we can see, right, so $13.22, $13.22. Next, I wanted to take a look at Asia, Pacific, Australia, and China. I think that's what APAC is. And here we have, these are the areas where some of the mobile gaming, mobile only services has arrived. And I wanted to see how the average return per users has changed. Because remember, I mentioned that if by a mobile only plan, you are increasing your paid memberships dramatically, because a lot of people are going to be enticed to go with this cheap plan, but at the same time you're going to see your returns go down. And we can see Q3 in this area was sitting at 4.4 million, nearly 14.5 million users. Now in Q4 it grew to 16.2 million users. But even though users increased, the average return per user decreased. Last quarter, average revenue per user was $9.29. This quarter was $9.07. And I would have to say one of the reasons here is most likely due to that mobile only plan, which reduces the amount of revenue collected per user. So next, what we're going to take a look at is this company's income statement. So here in the income statement, we can see operating income this quarter of Q4. The operating income was $458 million. The previous quarter was sitting at $980 million. And one of the main reasons we see this big change in operating income of about $500 million less this quarter compared to last quarter of Q3 is cost of revenue has increased. Cost of revenue this quarter was almost $3.5 billion, and last time it was at $3.1 billion. Another thing that's happening is they're spending a lot more money on marketing. Marketing last quarter was $553 million. Marketing this quarter was $878 million. And one reason I wonder if I'm pretty sure we're going to see it when the 10Q report comes out. But did that marketing increase? Was it a factor of the new competition? Did they increase their revenue to make sure that competition did not get much space from them? Here we're going to take a look. Here we also talk, I don't know if you guys remember, that I mentioned that this company had a form of benefit from taxes. And here this company had a benefit of $437 million. That's a lot of money. Definitely a lot of money that this company received back. And based on their weighted average per shares of 438 million shares, that benefit actually ends up being roughly about $1 of the earnings per share. And that's not counting the 300 they would usually pay. So $1 of earnings per share was actually based on the tax benefit. So we can change these earnings per basic shares to go about almost 34 cents instead of $1.34, which will be pretty similar to same time last year. So that's something to keep in mind out. Next, another thing I want to take a look at, we're looking at the company's balance sheet now. This company's total current assets has decreased from $9.7 billion last year to now sitting at $6.1 billion this year. So we can see current assets dropped by about 33%, but unfortunately current liabilities did not see that decrease. Current liabilities actually increased compared to same time last year. Same time last year was $6.4 billion, and this year is sitting at $6.8 billion. And you definitely do not want to see assets go down, total current assets going down, and total current liabilities going up. It's definitely not a good sight to see. And the final thing we're going to take a look at is this company's cash flow. And the only thing I want to see is look at this company burning cash. Right now, the non-GAAP free cash flow for this past 12 months was $3.2 billion. Same time last year was about $3 billion. And they're estimating for 2020 to be $2.5 billion. So that's actually a lot lower than these past 2 years. So like I said, I probably won't expect this company to be positive free cash flow till maybe about 2023, 2024, 2025. So that's it. I don't think I have anything else. I hope you guys enjoyed this episode. This was a quick one. I just wanted to take a look at the company's information that they released to us. So take care, guys. Have a good night and see you next time.